So guys, we are starting with the first chapter in managerial accounting. Now, many of you, well, you've all taken financial accounting, and you know with financial accounting, the focus was the bigger picture of accounting, dealing with external users outside of the company. This is a totally different process. We're still analyzing information and communicating this data, but it's to people within the company. Okay? So as a result of communicating to people within the company, it's going to be a lot more detailed, finite information to make real specific decisions. This chapter here is going to talk about how managers need information regarding different cost classifications for different purposes. So we're going to talk about how we go about assigning costs to specific jobs in this chapter. Here you see managerial accounting is concerned with providing information to managers within an organization so they can formulate plans, control operations, and ultimately make decisions that will be best for the company. So, hey, where are we getting our better profit? Do we want to increase this product, decrease manufacturing this product? Where's the need? Blah, blah, blah. So it's just more specific information they need. Now, this slide here talks about the types of cost classifications that we're going to be talking about in this chapter. Assigning cost to cost objects, and manufacturing companies preparing financial statements, predicting cost behaviors, and making ultimately business decisions. So, learning objective number 1, understand cost classifications used for assigning costs to cost objects, direct and indirect costs. So a cost object is anything for which cost data is desired, which might include products or customers, jobs, organizational subunits, for the purpose of assigning costs to cost objects. And they are classified or categorized in 2 ways. We're going to see either direct costs or indirect costs. So direct costs are costs that can be easily and conveniently traced to a specific unit of product or whatever cost object we're dealing with. Direct materials and direct labor. So think of like an auto factory. Those materials that directly go into making that automobile and the direct labor associated with individuals specifically working on that automobile would be direct costs. Indirect costs are costs that cannot be easily and conveniently traced to a unit of product. What that may be would be in a factory where this factory plant is, might be the cafeteria. Okay? That cafeteria is needed for that factory, but it's not really specifically linked to that automobile. Is it? Or the supervisor of the factory, or the insurance for the factory, or the heating. Do you get what I'm talking about? So all of those costs that aren't directly associated with that specific automobile will be lumped into a category that we'll probably call manufacturing overhead. These indirect costs happen because they're supporting a lot of different cost objects. These costs cannot be traced to any individual object. They're as a whole. Okay? Here we go. We've got Northwest Hospital here. And it's a full hospital providing major surgeries, outpatient clinics, emergency room. It's got the whole shebang. For each of these costs incurred that we're going to look at, let's talk about whether it would most likely be called a direct cost or an indirect cost of the specified cost object. So here, the cost is catered food served to patients. And the object we're focusing on is a particular patient. Can we target catered food served to patients? Can that be a direct cost for us? I'm going to tell you it can be. Why? Because we can determine exactly the food going to that patient. Make sense? So it's a direct cost because we can directly link that food for that patient. Does that make sense, what I'm trying to say? The next one, the wages of pediatric nurses. And if the cost object is the pediatric department, well, wouldn't you say it's fairly safe to be able to directly associate those nurses with that department? Does that make sense? What about prescription drugs and the cost object is a particular patient? I think you can, can't you? We can associate specifically what drugs go to which patient. And guys, it really matters because some drugs are pretty generic and inexpensive where others are thousands of dollars. It matters. How about heating the hospital? If we have an expense to heat the whole hospital, but our focus is just on the pediatric department, can we separate that cost? No, we can't. It's too big. It's for the whole hospital. So do you understand how that would be an indirect cost? How somehow we're going to have to take that cost and allocate it to the pediatric department, but we can't specifically know what's getting heated for the pediatric department. What about the salary of the head of pediatrics? If the cost object is the pediatric department, can we figure that out? Yes, we can. How about the cost object here is a particular pediatric patient? Can we take the salary of the head of pediatrics and apply it to a specific patient? No, we can't. How about for a particular patient, the hospital chaplain's salary? No. How about for a particular patient, lab tests by outside contractors? Yep, we could do that, can't we? I just went to the doctor on Monday and I had all kinds of blood work done. I hadn't had blood work done in a year. And so all those blood work, they're going to assign just to me. They're not going to link it to overhead and then take a piece of the cost and apply it to everyone. Those costs I specifically ordered for me. Got it? And then lab tests done by an outside contractor for a particular department. Instead of a particular patient, a particular department. Absolutely, we can link those. Does this help you understand what direct versus indirect costs mean? Okay, now we're going to look at 3 types of manufacturing cost categories. Direct materials and direct labor, we said, could be directly assigned to a particular cost object. Manufacturing overhead is a huge bucket of things we cannot directly assign. Direct materials are raw materials that become an integral part of the product and can be conveniently traced directly to it. So, a seat installed in an aircraft. Probably aircrafts aren't a good thing to talk about this week. Did anyone hear of the Alaskan airplane that lost its emergency window? Thank God no one flew out. The chair right next to it flew out, but no one was in it. Thank God. I know. It's giving me the creeps just thinking of it. Maybe that's not a good idea, but let's maybe think of a car and the metal for that specific automobile, or the paint, or the seats, or the radio, or the leather, or the glass. Do you see how we can assign direct materials specifically for that car? Okay. Direct labor. Direct labor costs are those labor costs that can easily be traced to individual units of product. So the wages of the assembly worker on the assembly line working on a specific car, don't you think that is easily traceable? Got it? Manufacturing overhead, guys, it's a huge catch-all. It's a huge dumpster. Manufacturing overhead includes all manufacturing costs except direct materials and direct labor. These costs cannot be readily traced to finished products. It includes all indirect materials that can't be specifically traced to a product, or indirect labor costs that cannot conveniently be traced to a specific product. Okay? Am I going too fast? Is this going okay? Whoops. So everyone showed up except Sonia, and I know she's not here today, so that worked great. Okay. Now, examples of manufacturing overhead. Depreciation on the manufacturing equipment. Utility costs, electric, water, sewer, trash. Property taxes on the factory. Insurance premiums on the factory. Only those indirect costs associated with operating the factory are included in manufacturing overhead. I want you to know, because you might be asked this, prime costs, conversion costs. Prime costs are direct materials and direct labor. They're prime, they're associated directly with the product, okay? Conversion costs include the direct labor and the manufacturing overhead. So when we talk about prime costs, just know there's DM and DL, direct materials, direct labor. Conversion costs are direct labor and manufacturing overhead. Non-manufacturing costs, those costs that don't get attached to products, but that are period costs, that go right on the income statement, are selling and admin costs. Selling costs are those costs necessary to secure the order and deliver the product. Selling costs can be either direct or indirect costs, but either way, they are non-manufacturing costs. They're not going to be flowing with the product until it sells, okay? Selling costs go right onto the income statement. Administrative costs are executive, organizational, and clerical costs. Administrative costs can either be direct or indirect costs. So guys, you might remember a little bit in financial accounting that when there's inventory, that inventory stays as an asset until you sell the good. Do you know what I'm talking about? Do you remember that? However, what we're saying here is selling and admin costs are not part of inventory. They're not part of the manufacturing process. They get put right on the income statement in the period those costs were incurred. Let's look at an example here. The PC Works assembles custom computers from components supplied by various manufacturers. The company is very small, and its assembly shop and retail sales store are housed in a single facility in Redmond, Washington, Industrial Park. Listed on the next slide are some of the costs that the company incurs. For each cost, indicate whether it would be most likely classified as direct materials, direct labor, manufacturing overhead, selling, or admin. What about the cost of a hard drive installed in a computer? Any thoughts?
Direct material.
Excellent, direct material. Next one. Now, I'll never call on you, but it's nice when, and guys, we're learning. Make mistakes. You're going to make mistakes, okay? The cost of advertising in the Puget Sound computer user newspaper. It is, but okay, but manufacturing overhead would be specifically applied to that product. In this case, wouldn't this be selling costs? Selling? You see what I'm saying? Advertising is a selling expense. So it's not a manufacturing cost. I mean, it's a selling cost. It's not overhead of a factory. Got it? So next one, the wages of employees who assemble computers from components. Direct labor. Next, sales commissions paid to the company's salespeople. Selling? Okay, they're selling the products. Remember, guys, we separate out all the costs associated with making the product from the selling and admin. All the costs associated with making the product stay as inventory until the product sells. The selling and the admin costs are direct expenses, or we call period costs. They get written off as they're incurred. Next, the salary of the assembly shop's supervisor. Someone said it earlier. Overhead. Think about it. The assembly shop, this is part of the manufacturing, but it's not linked with a specific product. It's the supervisor. So that would be part of manufacturing overhead. Okay? Because it's not, this is part of the manufacturing. Administrative would be the CEO, the executive, the payroll department, the marketing department, who runs the company. But the shop supervisor is part of manufacturing. He's in the warehouse manufacturing the goods, but we can't assign his salary to a specific product. That's why he's overhead. Does that make sense?
Yes.
Okay. But guys, thank you for asking questions. That's how we learn. The salary of the company's accountant, administrative costs, depreciation on equipment used to test assembled computers before release to customer. Yes, excellent. Rent on the facility in the industrial park. So we don't know Does this facility have a manufacturing piece? Does it have admin offices? Blah, blah, blah. So what we're saying here, it's going to be a mixture of manufacturing overhead for the warehouse department or the manufacturing department, and the selling and admin. If they're housed in this industrial park, then we'll allocate some of those costs to them. Okay? So basically what we're trying to do is get an understanding of how we're going to assign costs. Okay? Direct materials, direct labor, those are specifically linked with a product. Manufacturing overhead is everything in that manufacturing arena that can't be specifically linked to the product. Selling and admin are what we call period costs that get assigned to the income statement. They are not assigned to the manufacturing process. Now we're looking at preparing financial statements. Product costs are all costs involved with making or acquiring a product. Product costs attached to a unit of product as it's purchased or manufactured, and it stays with that product as long as it's in inventory awaiting to be sold. Product costs include raw materials, work in process, and finished goods. So as we're working on a product, we're going to take materials to build a computer. We're going to take the hard drives. We're going to take the screens. We're going to take the memory. Okay? Those are all raw materials that are getting assigned, that are being used to go into that final product. Work in process are the units of product that are only partially complete at the end of the period, and they require further work to get them ready to be sold. So basically, work in process, guys, are those products that are still in process but haven't been completed yet at the end of the period. And then finished good costs are those products that are all done. They're waiting to be sold, but they're not sold yet. It consists of completed units of product that have not yet been sold to customers. Does that make sense? Yes? No? When direct materials are used in production, their costs get transferred from the department they're in, called raw materials, into what we call work in process. As they leave the raw materials warehouse and they go into production, they get transferred into a new subset of product costs called work in process. Direct labor and manufacturing overhead costs get added to work in process to convert the direct materials ultimately into finished goods. Once the units are completed, then it's at that time when they're completed, they're ready to be sold, they get transferred out of our work in process section and they go into finished goods. When a manufacturer sells its finished goods to customers, then it goes out of finished goods and goes into cost of goods sold, which is an expense on the income statement, right? So we know raw materials, work in process, and finished goods, they're all subsets of inventory. And inventory is a current asset on the balance sheet. Cost of goods sold is an expense on the income statement, isn't it? So we know the product costs flow through the accounting system as raw materials into work in process, into finished goods, until they ultimately hit the account cost of goods sold, which ends up on the income statement. All period costs, like selling costs and admin costs, go right to the income statement as an expense. Excuse me 1 second, guys. Okay. Let's look at this question. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? B, yes, those property taxes on the corporate headquarters isn't part of manufacturing, so excellent. Also, a period cost would be anything to do with selling and admin, right? So all sales commissions would also be a period cost, not a product cost. Suppose you've been given a summer job as an intern for Isaac Aircams, a company that manufactures sophisticated spy cameras for remote-controlled military reconnaissance aircraft. The company, which is privately owned, has approached a bank for a loan to help finance its growth. The bank requires financial statements before approving the loan. Classify each cost listed on the next slides as either a product cost or a period cost for the purpose of preparing financial statements. So let's start with depreciation on salesperson's cars. Anything to do with selling is what? Period. It's going to be a period cost. Okay? How about rent on equipment used in the factory? What's the tell-all here? Factory, right? Now, equipment used in the accounting department would be a period cost. Equipment used in the selling department, but because it says factory, what is this? Product. Does this make sense, guys? Lubricants used for machine maintenance. Product. Now, we know that's probably a manufacturing overhead, but it's still a product cost. Okay? Salary of personnel who work in the finished goods warehouse. Product. Period cost. Okay, I've done this wrong before. It's done. I've done this before. In my mind, I'm still thinking it's being manufactured. It's done being manufactured. Okay? So the finished goods warehouse would be a period cost, guys. I'm sorry. It's finished. It's over. It's done. The manufacturing is completed with it. So it's a period cost. Soap and paper towels used by factory workers at the end of the shift. Factory, what is it? Product. See the difference? Factory supervisor salaries, product. Heat, power, and water consumed in the factory, product. Materials used for products for shipment overseas. Units are not normally boxed. They would be period costs. Okay, it's selling. Advertising costs, period. Workers' compensation insurance for factory employees, product. Are you getting the theme? Depreciation on chairs in the factory lunchroom, product. The wages of the receptionist in the administrative office, period. It didn't say factory, right? Cost of leasing the corporate jet used by the company's executives, period. Okay. The cost of renting rooms at a Florida conference for the annual sales conference, period. The cost of packaging the company's product. Okay. The packaging of it is like getting it ready. The reason the other one was a period cost is it normally is not packaged. Do you see the difference? So if this is part of the final product, to package it, it would be a product cost, okay? Make sense? Now, see, this chapter's all full of different costing, different ways of determining costing. Now we're going to look at various costs used to predict cost behavior. We're going to talk about variable costs, fixed cost, and what we call mixed costs. So, a cost that varies in total in direct proportion to changes in the level of activity would be called a variable cost. Per unit would be constant. So when before we start talking about this, we need to look at what we call a cost driver. A cost driver is that measure of what causes a variable cost to happen. It can be machine hours. It can be labor hours. It could be units produced, or it could be miles driven. It's what we can use to help determine how costs can increase. So based on the number of machine hours is probably based on how much work is being done. Okay? Or labor hours, how many hours they're putting in probably drives the variable cost. Miles driven as far as a vehicle goes, or number of units produced. A fixed cost will remain constant regardless of changes in the level of activity. If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes in activity. Okay? So, we have fixed costs that can be committed, that can't really be reduced, and fixed costs that can be discretionary, that can somehow be altered in the short term. So if you look here, one side of the graph shows all the total costs, and the horizontal line shows the activity level. If there's a straight line, it basically shows that the approximation is pretty much constant related to the unit variable cost. all within a relevant range. So this linear assumption in relevant range. In other words, we can have costs, but if we then have to go and add a whole new factory, that changes our scenario. So there's a relevant range for products that can be handled in a specific factory. Fixed cost and the relevant range. The relevant range of activities pertains to fixed cost as well as variable cost. So example is, if we have office space that is available at a rental rate of $30,000 per year in increments of 1,000 square feet. So if all we need is 1,000, if we've got our fixed cost assigned because this is the amount of square footage we need, it's a fixed cost. However, if we all of a sudden need to bump up and have more office space, do you see how that fixed cost is going to increase? Because all of a sudden we need more space. So it is a fixed cost within the relevant range of using that many square feet, is the point of the relevant range. So the relevant range of activity for a fixed cost is the range of activity over which the graph of the cost is flat. So as you see, if, let's just say in Oka Ramsey, we are using one building, that fixed cost, if we say we're renting the space, is fixed. However, if we say all of a sudden Anoka Ramsey has grown and we need another 50,000 square feet, do you see that's really not, it is a fixed cost, but the relevant range has changed because now we need more space because we've grown. Am I making sense? We have variable costs, and in total, the variable cost increases and decreases in proportion to changes in the activity level. However, the variable cost per unit is going to remain constant. Example, we are manufacturing a computer. For building this computer, we need $80 worth of products. Okay? So per unit, this variable cost of $80 is going to be constant. But if we build 100 of these units, how much are our costs? Per unit the same, but in total more. Do you understand the difference? So variable cost per unit stay the same, but as you produce more, the cost is going to be higher. However, the fixed cost is not affected by changes in the activity level within the relevant range. So if we can do all of our manufacturing in this 5,000 square feet, it's a fixed cost, no matter how many we're building right now. Fixed costs per unit decrease as the activity level rises. So if in 1 month we only made 10 computers, that fixed cost is still going to be the same amount. But those costs are going to get a higher amount assigned to this one computer. However, if 1 month we produce 500 computers, that fixed cost is still the same for rent. But per computer, it goes down. Does that make sense? Yes? No? I'm not getting your feedback. Which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin Robbins? Would the lighting the store change? No, that's a fixed cost, isn't it? The wages of the store manager, would that change? But wouldn't the cost of ice cream and the cost of napkins vary based on how many ice creams are sold? Okay, doesn't that make sense? Listed on the next slide are costs of providing an airline service. Classify each cost as either variable or fixed and direct or indirect. Consider the cost object to be the flight. Flight attendants or pilots are paid on hours of flight time. So we're going to look at the cost of this flight, okay? So advertising. Is advertising a variable expense or a fixed expense? I'm giving it to you. It's a fixed expense. And is that advertising specifically related to that flight? No, it's not. How about this? Beverages served on a plane. It's a variable expense. They might not be too thirsty from 1 a.m. to 5 a.m. Okay? But maybe from 6 to 9, they're going to be drinking a lot more. And can't you assign directly to that flight how many drinks were served? That makes sense? Or what about the regional VP salary? It is a fixed expense, but it's not directly associated with that flight, is it? The regional VP salary is overseeing a bunch. How about depreciation on ground equipment? It's a fixed cost, but that is an indirect cost to that flight. Fuel used for planes. You know, if they're just going from here to Milwaukee, they're going to use a lot less fuel than if they go from here to Tokyo, right? What about flight attendant wages? Some flights only have 3 flight attendants. Some flights have 8 flight attendants, right? How about pilots' wages? And what about the aircraft manager's salary? Isn't that going to be indirectly related to this specific flight? Yes? Is this boring? I'm trying to read you. Are y'all tired? It's a lot of knowledge all at once. So, we talked about fixed. We talked about variable. Now we're talking about mixed. A mixed cost contains both variable and fixed elements. Think of utility costs. They can charge a flat fee no matter what, and then based on usage. Yes?
Is salary always going to be fixed? Wages will be...
Well, it depends. Some of those salary, so like the pilots and the flight attendants were variable based on...
they work on hours.
They work on hours, and some planes might require 2 pilots, some might require 3. Do you see what? Or sometimes if they're flying overseas, they might have to have a backup crew because they're going to go over their duty time. But the salaries of the VP and all that, those are fixed costs. You see, when they're trying to assign cost to a specific flight, the pilot salaries, if it's just to Milwaukee, it's an hour of flying. If it's to New Orleans, it's 4 hours of flying. You see, and how the wages are going to vary because they do get paid by the hour. That is correct. Maybe I needed to say that. Pilots don't get paid by a flat amount each month. They just get paid by the hour. I mean, there are different guidelines and every company is different, but for the most part, they get paid when they're in the air. From the minute they push back on the gate till they push to the gate, they get their clock's ticking. So in this case where there's a mixed cost, then there's a flat amount and then there's an amount of usage. The total mixed cost line can be expressed as an equation where Y is the mixed cost, A is the fixed cost, the vertical intercept of the line, you know, from here, right from here to here. B is the variable cost per unit of activity, and X is the level of activity. So if your monthly utility charge is $40, your variable cost is 3 cents per kilowatt hour, and your monthly activity level is 2,000. What is the amount of your bill? Well, you can see you take the $40 plus the 3 cents times 2,000 kilowatt hours to give you your $100. This is what we're saying is a mixed cost. Okay, we've had a lot of talking about costs. Now, and I'm sure you guys have heard this in other classes, sunk cost, opportunity cost, and differential cost. Sunk costs have already happened. There's nothing you can do about them. They've already been incurred. They're done. Opportunity costs are the costs that you could have had if you weren't doing what you're doing. Okay. Northeast Hospital's radiology department is considering replacing an old inefficient x-ray machine with a state-of-the-art digital x-ray machine. The new machine would provide higher quality x-rays in less time and at a lower cost per x-ray. It would also require less power and could use a color laser printer to produce easily readable x-ray images. Instead of investing the funds in the new x-ray machine, the laboratory department is lobbying the hospital's management to buy a new DNA analyzer. For each of the items, indicate by placing an X in the appropriate column whether it should be considered a differential cost, a one or the other, a sunk cost, or an opportunity cost, and the decision to replace the old x-ray machine with a new machine. If none of the categories apply, leave them blank. So the cost of the old x-ray machine has already happened. We've had it. It's there. It's history. It really doesn't come into play in our decision making. The salary of the head of the radiology department Sorry, I'm just trying to figure out what's going on here. So the salary of the head of the radiology department and the lab department just isn't any of those. It's not a differential cost. It's not a sunk cost. It's not an opportunity cost. It's none of them. Okay? The cost of the new laser printer does matter, one or the other. Okay? This would be a differential cost. It would play out in the decision making. The cost of maintaining the old machine, that would be a differential cost, one or the other. That would play out in the decision making. The benefits from a new DNA analyzer, these would be costs if they chose to do this instead of the other. Okay? Cost of electricity to run the X-ray machine, wouldn't that be a differential cost? If you're using the old X-ray machine, that cost should be taken into account. It's ongoing. Okay? When you're comparing the two, you want that to be considered. The cost of the salaries of the head of radiology and lab departments and the rent on the space are neither differential, opportunity, or sunk costs. These costs do not differ between the two alternatives, and so they don't matter in making this decision. They're irrelevant. Okay? They're not sunk costs because they occur in the future. Sunk costs are those that have already happened and you can't do anything about them. Make sense? Now, we're going to talk about relevant and irrelevant costs. Decisions involving choosing between alternatives. The goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision. We need to understand the various concepts in order to help us in decision making. The differential cost, one or the other, are the difference in cost between any alternatives. A difference in revenue between two alternatives is a differential revenue. Both are relevant to making this decision, and differential costs can be fixed or variable. Okay? Differential costs are needed in helping us derive at a decision. Opportunity cost is the benefit that gets given up when one alternative is selected over another. So we're not going to see them, but we have to take them into account. By you being here right now, what are you giving up? Maybe working, maybe having fun. But you're doing it, why? Because you believe your life is going to be better for it. Okay? Sunk costs are always irrelevant. These irrelevant costs, sunk costs, have already happened. They can't be changed. It doesn't matter about now and the future. They should be ignored when making decisions. In business decision making, a sunk cost is a cost that's already been incurred, cannot be recovered. Sometimes they're contrasted with prospective costs or future costs that would be incurred or changed if an action is taken. But sunk costs are done and gone. So guys, suppose you're trying to decide whether to drive or take a train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money. Is the cost of the train ticket relevant to the decision? Yes. It's a differential, wouldn't it be? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? Yes. The cost of the train ticket matters. Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You don't want to waste money. Is the annual cost of licensing your car relevant? No. Suppose that your car could be sold now for $5,000. Is this a sunk cost? Well, it's not a sunk cost. It hasn't happened. Sunk costs have happened. Okay? Suppose your car, so anyway, does that help you understand? Sunk costs don't matter for making decisions. I think this is our last objective. Maybe there's one more. So we touched on this a little in financial accounting, but preparing income statements for merchandising companies, we're going to use two different methods, the traditional and the contribution format. You see, using the traditional, we just show, as we would with external reporting, our sales, our cost of goods sold, our gross margin, selling and admin, and then net income. But under the contribution format statement, which is used internally only, we separate out variable expenses from fixed expenses. Okay? Because that gives, even though the bottom numbers are the same, it allows us to see how much of the sales minus those variable expenses go to pay our fixed expenses. You see, under the contribution format, we show our sales minus our variable expenses to be the contribution margin, the amount that can be contributed towards our fixed expenses. So we're going to look at some other things down the road at how a contribution, but we're not going to worry about that right now. Here we've got a piano company. Purchases pianos from a large manufacturer for an average cost of $2,450 per unit and sells them to retail customers for an average of $3,000 $125 each. And here are the various expenses shown. Advertising, it's monthly. Salaries and commissions is kind of fixed and a little bit of variable there. Mixed, I should say. Delivery of pianos per piano sold. The utilities are fixed. Depreciation on the sales facilities fixed. Insurance, salaries, fixed. Clerical, a little bit of mixed. And depreciation is fixed. During August, Marwick's Pianos sold and delivered 40 pianos. The first thing we'll do is prepare a traditional format statement. Then we're going to prepare a contribution format statement, because remember, with the contribution format, we separate the variable cost from the fixed cost. And then let's look here. So here, using the traditional, we just take our sales, we take the cost per the number of pianos sold of $24.50, and we've got our gross margin. Then we have our selling and admin expenses broken down, and we show a net operating income here. If we do the contribution format, we are taking and showing all the variable expenses. So we've got the cost of the pianos, the sales commissions, the delivery of the pianos, and the variable sales portion per piano, to then arrive at our contribution margin. After that, we show all of our fixed expenses to come up with our net operating income here. Does that make sense? So the numbers are ultimately the same here. Our net income is the same, but the way that we show it, display it, is different. Fixed costs remain constant in total, but vary on a per unit basis inversely with changes in the activity level. So as the activity level increases, like more pianos are sold, the fixed costs will decrease on a per unit basis. Showing fixed cost on a per unit basis on the income statement would mislead management into thinking that the fixed costs behave in the same way as variable costs, but they don't. The fixed are fixed no matter what. For this reason, fixed costs generally are shown only in totals on a contribution statement. Okay? Let me see. Oh, we're doing okay. Dake Corporation's relevant range of activity is 3,200 to 8,000 units. When it produces and sells 5,600 units, its average costs per unit are shown right here. So we see the average per unit when it sells 5,600 units. If 4,600 units are produced, the total amount of indirect manufacturing costs incurred is closest to what? I'm going to give you about 3 minutes while I post this one lecture to try to figure this out, okay? And then we'll go over it together. Is that all right? Okay, sorry about that. Okay, so what they're asking, what is the amount of indirect manufacturing costs? So indirect manufacturing costs wouldn't include direct materials or direct labor, right? But they would include the various manufacturing overhead, right? So let's just see, where did I just screw up? So what we're going to do is 130, the variable manufacturing overhead per unit. Do you see it's 130 times 4,600 units would be 59.80. And then this, $3 fixed manufacturing overhead here. This is the fixed. Now think of this. When it produces and sells 5,600 units, its average cost is as follows. Since this is fixed, it's not going to change. So even though we produced 4,600 units, we need to take that entire fixed manufacturing overhead amount. Does that make sense? So they gave us $3 per unit if we did 5,600 units. But because it's a fixed category, we have to take that whole amount. It doesn't matter we only produced 4,600 units. Those fixed still stay fixed. Okay? So the total indirect manufacturing cost for manufacturing 4,600 units is still $22,780. The average fixed manufacturing overhead cost per unit was determined by dividing the total fixed manufacturing overhead by 5,600 units. But guys, it's fixed. So even though we just produced 4,600 units, that fixed manufacturing overhead is still going to be $16,800. Okay? Which of the following would most likely not be included as manufacturing overhead in a furniture factory? What do you guys think? I think the amount of person who stains the chair is going to be a direct labor, wouldn't it? That would be a direct labor. Okay. Same concept there with those couple. Following costs were incurred. So basically, some of these. This particular problem, what we're doing, again, we're still looking at the various classifications of cost. So when they talk about conversion costs, remember prime cost are direct materials and direct labor, but conversion costs are direct labor and manufacturing overhead. Remember that from the earlier slide. So the conversion costs are going to be the 29.1 plus the 26.1 to give us the 55.2 for conversion cost. Okay? You just have to remember the wording. Oh, guys, I've just got a ton here for you. But what I want to do is have enough time so we can go over your homework here.